Welcome back to our channel, where we dive deep into all things finance and investing. In today's video, we'll be exploring a topic that has been on everyone's minds lately: how a recession affects the stock market. We'll take a closer look at the relationship between recessions and the stock market, the factors that drive stock prices during economic downturns, and some strategies investors can employ to navigate turbulent times. So, grab a pen and paper, because we're about to break it all down for you. Before we dive into the nitty-gritty, let's start by understanding what a recession actually is. A recession is a significant decline in economic activity, typically characterized by a contraction in GDP, gross domestic product, rising unemployment rates, and a general slowdown in various sectors of the economy. Recessions are part of the natural business cycle and can be caused by a variety of factors, such as changes in consumer spending, shifts in government policy, or financial crises. Now, let's explore how recessions impact the stock market. During a recession, it's common for stock prices to experience significant declines. This is primarily because companies' earnings tend to decline as consumer spending slows down, leading investors to reevaluate the future profitability of these companies. As a result, stock prices may fall as investors sell their shares, fearing reduced profits and uncertain economic conditions. However, it's important to note that not all stocks are affected equally during a recession. Some sectors, such as consumer staples, e.g., food, beverages, and household products, healthcare, and utilities, are considered more defensive. These sectors are relatively less impacted by economic downturns because people continue to consume essential goods and services, even during tough times. On the other hand, sectors like retail, travel, and luxury goods tend to be more sensitive to changes in consumer spending and may experience sharper declines during recessions. The stock market's reaction to a recession is not always immediate or straightforward. In some cases, stock prices may begin to decline well before the official announcement of a recession, as investors anticipate economic weakness. Conversely, the stock market may also start to recover before the recession officially ends, as investors anticipate a future rebound in economic activity. Therefore, it's crucial for investors to pay attention to leading economic indicators and market sentiment to gauge the potential impact on stock prices. Now, let's delve into some factors that drive stock prices during a recession. One of the key factors is corporate earnings. During a recession, many companies experience a decline in sales and profitability, which can negatively impact their stock prices. Investors closely monitor earnings reports and adjust their expectations accordingly. Companies with strong balance sheets, stable cash flows, and a history of weathering economic downturns may be viewed as more resilient and attract investor confidence even during challenging times. Another factor to consider is interest rates. During recessions, central banks often implement monetary policy measures to stimulate the economy. One common tool is lowering interest rates, which makes borrowing cheaper and encourages consumer spending and investment. Lower interest rates can have a positive impact on stock prices by making alternative investments, such as bonds or savings accounts, less attractive relative to stocks.